Financial Ratio Analysis Part 2 Lecture 9 Lecture Outline. Hello, welcome to Lecture 9 of Equity Master Secrets. This lecture is Financial Ratio Analysis Part 2. And what we're going to start off by doing in this lecture is we'll continue our discussion on financial statements and ratios that we looked at in the last lecture, and we'll look directly at an example. So we'll look at Maruti Suzuki and the financial statements and ratios for this company. Once we're done talking about Maruti Suzuki, we'll then move on to talk about return on equity. Next, we'll move on to talk about DuPont analysis. And DuPont analysis is a way in which we break down return on equity into different components. We'll talk about the uses of DuPont analysis. And then we'll talk about a few different examples where we look at the DuPont analysis and the return on equity analysis. So we'll look at HDFC Bank, Hindustan Unilever, and National Mineral Development Corporation. And then after that we will conclude. Okay, let's get started. Maruti Suzuki. So the first part of this lecture, we want to look at the financial statements and some financial ratio analysis of Maruti Suzuki as an example. So here we have an Excel spreadsheet which has the company's accounts as well as some ratio analysis. So the accounts are the first part of this spreadsheet. So we first have the profit and loss statement. Now I won't go through these items because we already saw it in the previous lectures. So it'll be, we saw the annual reports and these statements were there. Here we have it for more years, so this allows us to look at the ratios over different years. But it's pretty straightforward in terms of what we're interested in here. So net sales is something that's interesting for us, and operating profit as well as profit after tax. So the kind of the main numbers that we care about when we're going to be doing the financial ratio analysis. And then we have equities and liabilities, so shareholders' funds, and then current, non-current, and current liabilities, and total liabilities. Then we have assets, again broken up into non-current assets and current assets. And then we have the cash flow statement. Okay, so we're going to start over here where it says financial ratio analysis, and this is kind of the main area that we are interested in looking at. Okay, so we talked about all the different ratios that were out there. So let's look at how we calculate these ratios. So profitability ratios, we have the operating profit margin. Okay, we have that for each year. We have the net profit margin, and we have the effective tax rate. Okay, and you can see these for Maruti over the course of the 5 years. And this is to kind of give you an example of what these ratios might look like. All the calculations, some of them, they'll all be based on the formulas that you see in the spreadsheet, but you can certainly go back to the previous lectures to look at the formulas for each of these items. So here we have the return ratios, return on equity, net operating profit after tax, capital employed, return on capital employed, return on assets. And again, all these formulas, you can look at what numbers are being divided in order to understand where these numbers come from. Then we have debt ratios. So we have debt to equity, interest coverage. Then we have free cash flow total debt and free cash flow to debt. Next we have liquidity ratios, and in this one we have the current ratio is the main one that we're interested in. Next we have asset utilization ratios. We look at fixed asset turnover, inventory days, receivables days, payables days, and cash conversion cycle. Then we have cash flow ratios, where we have operating cash flow to sales, free cash flow to operating cash flow, and dividend payout. Then we have the valuation ratios. So here we have quite a lot of them. We have the closing price per share, and this is the average closing price per share, with the price to earnings ratio, adjusted book value per share, price to book value, average market capitalization, total debt, cash and equivalents, enterprise value, EV over EBITDA, sales per share, price to sales, dividend yield, and price to free cash flow. And finally, we have the DuPont analysis, which is the net profit margin, the asset turnover, and the financial leverage. DuPont analysis we'll talk about in great detail in this lecture, and we'll talk about the three components, which are profit margin, asset turnover, and leverage, that actually make up the return on equity. So as you can see here, we have a whole bunch of financial ratios for this company, and this should cover all the ratios that we have seen in our lectures. And the purpose of this is for you to really look at, understand in practice, how do we calculate them and how do we organize it so that it's easy to see. So when we can really use these ratios to look at the trends of companies and to see what they're doing. So you can see, for example, a net profit margin, it's going from 6 to 8.6 to 6.2, then it's fallen significantly, and then it's come back a little bit. So we really can use these numbers to gain an idea of what the company is doing, what is their current trend. Is their performance improving, not improving, and obviously we want to take into account the fact that these numbers will be affected by things that are going on in the economy, like when there's a slowdown or recession, then we should expect lower margins and lower sales. And I would highly encourage you to actually go through each of these items and make sure you understand exactly what it means, right? So hopefully with these lectures, you're in a position where you should be able to understand each of these lines, and that's really what's very important here, right? You should be able to look at each line and understand, how we can calculate this. Obviously, you don't need to memorize exactly how to calculate each thing, but you should certainly understand what it means, and you should certainly be able to look at, how it's calculated, and that should make sense to you, right? So, if I have net profit margin, for example, it says you're equal to B60, so I can go up to B60, okay? And net profit margin is here, and then this is calculated as the B58 profit after tax divided by B8, which is going to be net sales, right? And that makes sense, right? Profit divided by sales, and this gives us the profit after tax, right? So any of these items, I should be able to understand where they're coming from, and I should be able to look through the financial statements and be able to figure it out, right? So that's what's key here. So make sure you definitely go through this Excel sheet. So this Excel sheet will be included with the lecture that you'll be able to download. So make sure you download this Excel sheet and take a look at all of these line items and make sure you understand each one, and in particular the financial ratios that are quite important. So when we do valuations, when we look at how to value companies, we'll make heavy use of the different financial ratios. So as a result, it's really important to understand it well. Okay, so now we've had a chance to look at Maruti and its financial ratios. We're going to go back to the PowerPoint, and now we're going to move on to the next topic in financial ratios, which is DuPont analysis, which we just talked about, looking at the components of ROE. So we'll talk about that now in a lot more detail. Return on equity. So now that we have had a chance to look at a detailed example of Maruti and its financial statements and ratios, we're now going to move on and talk about return on equity, and we'll follow this by talking about DuPont analysis. So what is return on equity? Return on equity measures how well the company uses its shareholders' funds to generate profits. So what do we know of equity? Well, equity is the total assets of the company minus its liabilities, so it's equivalent to the shareholders' value of the company, or the shareholders' equity stake. And when we look at return on equity, we're looking at how much do they earn given the equity that they have, right? So for a given amount of equity, how much do they earn? And that percentage number will be the return on equity. So the way we calculate it is that we take net income, so profit after tax, and then we divide it by shareholders' equity, share capital plus reserves. And here you can see the formula mathematically. So return on equity is equal to net income divided by shareholders' equity. And one thing to keep in mind here is that the shareholders' equity is the book value of equity, not the market value. So when we are looking at what is a company's return on equity, we want to know the book value of their equity, not the market value. And one reason we do this is that the market value tends to fluctuate a lot. So if stock prices go up, then the market value would be very high, and vice versa if they went down. And we don't want this return on equity to be measuring how the stock price is moving, right? We want something that's a bit more stable, and something that actually reflects the funds that the company has, which will be its share capital and reserves. So that's why we would calculate shareholders' equity using the book value of equity. Now, in general, when we look at return on equity, a higher ROE is better, typically. A higher ROE implies that the company is better at generating returns for a given book value. Now, I say that higher return on equity is usually a good sign, but there are instances where that might not be the case. And we will look at some examples of when we look at DuPont analysis, we'll see the drivers of return on equity, and then we can perhaps better understand what constitutes ROE and when high ROE is good or it's not good. Okay, so ROE, as you know, is a very common statistic. We do see it a lot in financial analysis, so that's why it's very, very useful, and that's why it's something that we study in a fair amount of detail. Right, we're going to be devoting most of this lecture to understanding ROE, because DuPont analysis is breaking down that ROE into its components. And when we look at the different examples that we have, we'll again be looking at it in the context of, how do we understand their ROE using DuPont analysis and using the methods that we have to break down the return on equity. Okay, so now what we're going to do is we'll carry on and we'll talk about DuPont analysis and the components shortly. DuPont analysis. So the next thing we're going to talk about is DuPont analysis. And this is very much related to return on equity, as we mentioned. So what is DuPont analysis? The DuPont identity breaks down return on equity into three components. Now let's just focus on the word identity here. So when something is an identity, it means that it is equal to something else, and that holds all the time, regardless of what's going on. Right? So for example, when we say that total assets equals liabilities plus equity, that's an identity. So that's going to hold regardless of what happens to if assets change or if liabilities change. Then the equation still always holds. Right. So it's the same thing with this DuPont identity. It's going to be sort of breaking down return on equity into its components and into an identity equation that always holds regardless of what's going on. So why do we care about DuPont analysis, and why do we care about breaking down the ROE? Well, the thing is, as we mentioned, ROE is a very useful statistic, but it also encompasses a lot of different things. There are multiple factors that could be driving the ROE, and sometimes these factors may imply the company is doing well, sometimes maybe not. So that's why we want to look deeper into what is constituting the return on equity in order to understand how a company generates its returns. So the return on equity is equal to the net profit margin times the asset turnover times financial leverage. And we're going to talk about each of these three things in a little more detail. But briefly, net profit margin is sort of the percentage return in terms of your profits divided by your sales or revenues. Asset turnover looks at your turnover relative to your assets, so your sales over your assets. And financial leverage will look at how much debt you carry, or how levered the company is with regards to its debt equity split. So here we have the formula in a slightly easier way to read. So ROE is equal to net income over sales. That's the net profit margin. And then we have asset turnover, which is sales over assets. And then we have financial leverage, which is assets over equity. So what you can see from this equation is that ROE, as we know from earlier, is equal to net income over total equity. Right, so this is an identity because if you were to simplify this equation, you could see that you could cancel sales from the numerator and denominator, you could cancel assets from the numerator and denominator, and you would get net income over equity. Right, so that's why this is an identity and it always holds. So these are the three components of return on equity, and in order to understand the ROE for a company, we should look at each of these three components and see what is driving the higher return on equity. So of course, as we mentioned, this is an accounting identity. Okay, so this is like the assets equals liabilities plus equity. It's that type of identity, so it always holds. Alright, and now what we're going to do is we're going to go ahead and talk about these three components in a bit more detail. So we'll look at net profit margin, asset turnover, and financial leverage in a little bit more detail. Net profit margin. So what is net profit margin? It is the first component of the DuPont identity. As we saw earlier, it's equal to the net income over the total sales. And what net profit margin measures is that it measures a company's profits as a percentage of total sales. Right? So if you think about sales as being your revenue, right? So if I'm selling an item for 100, that may be my revenue, and then the portion of it that is my profit, right? Let's say that would be 10, then my net profit margin would be 10%, right? So I take my revenue, subtract all my costs, including taxes and everything else, and it's what I'm left with at the end. So if a company earns revenues of 100, and let's say after all its costs it has 15 left over, then the net profit margin is 15%. So it's a pretty straightforward number and a pretty straightforward calculation. In general, you can always find net income on a company's financial statements. So if you go to its income statement, it'll be the profit after interest, depreciation, and taxes. So the key thing about net income is that it's looking after everyone has been paid, right? So all of the company's costs have been covered, and it's what is left over. And this would be the net income. So here we have the calculation. Net profit margin is equal to net income divided by sales. And sales, as we mentioned, is the company's revenues, so that you would also find on the income statement. And then you can easily calculate net profit margin. So as you can imagine, net profit margin, the higher it is, the better. And this is fairly universal. We want profit margins to be high as possible for companies that we're interested in. Typically, you will see a lot of variation in net profit margin depending on the industry. So industries that are high volume and high turnover businesses may have very low margins, but they may still be very profitable because of their turnover. And for certain things, for example, like luxury items where the turnover is quite low, but their profit margin for each item is quite high, and that's how they tend to generate their income. So you do see a considerable variation in net profit margin across industries and across companies, but we can say, fairly surely that higher net profit margin is generally better. Asset turnover. So as we said, the second component of return on equity is called asset turnover. And asset turnover is looking at the company's turnover, which is sort of looking at how much its sales are relative to its assets. The way we calculate asset turnover is that we take the total sales of a company and we measure that as a percentage of the total assets. So there's the formula. We take sales and divide it by assets. So again, fairly simple, fairly straightforward. These are both items that are easily found on the company's financial statements. So sales you will see as revenues or something like that on the income statement. And then assets will be on the balance sheet, and you'll see the total company's assets there. And here what we are measuring is how well does a company use its assets in order to generate sales. Right? So your assets can be things like factories or machines or something like that you use to make your goods. And assets also includes your cash as well as other things, other current assets. But a lot of the assets that we might be interested in are the longer term assets, the fixed assets that are actually being used to produce the goods that are making their sales. So we're looking at how well does a company use its assets in order to generate these sales. And typically, just like with net profit margin, you'll see considerable variation across different industries. So one thing that's very prevalent is that in some industries have very high turnover, especially things like retail, where you may have very low profit margins, but because you just sell a lot of items, right? So you have a very high amount of sales relative to your assets, you become profitable that way, and you increase your return on equity that way. So that's why asset turnover is quite important, right? Because it does measure, how much can you sell relative to the total assets that you have. So as we mentioned, it is often the case that companies with low profit margins have higher turnover. So, for example, a grocery shop, or really most kind of retail tends to be in this category, with the exception of luxury retail. So luxury retail tends to have low turnover but high margins. But most retail items tend to have fairly low margins and high turnover. And in general, we would always say that a higher asset turnover is better. So if a company has a higher asset turnover, it means that they're able to sell more for a given amount of assets in a given time period, and then this is positive. It means that they are doing well. And the ROE is divided into these three components, and obviously an increase in any one of these components leads to an increase in the return on equity, right? So if we have a higher asset turnover, it means that our return on equity is going to go up, right? And this is something that we think is a good thing. So we generally want to find companies that tend to have a higher turnover, depending on, of course, on the industry that we're in. And one thing to keep in mind is that when we calculate asset turnover, as we know, sales, and this is something that comes from the income statement, which is measured over a period of time, so let's say over 1 year or 1 quarter, whereas assets is a snapshot at a particular point in time, right? So one way to make this comparison a little bit easier or more correct is to use average total assets. So for example, if we're looking at sales over a 1 year period, we would use the average assets over that 1 year. So we might take the assets at the beginning of the year and the assets at the end of the year and take the average, right? So that way we get a more correct figure of what the assets were throughout the year. Financial leverage. So the last part of the DuPont analysis identity or equation is financial leverage. Financial leverage measures total assets over equity. So here we can see the formula. It's financial leverage. We take the total assets and divide it by the total equity. So let's think about how exactly does this measure total leverage. We know that debt plus equity is equal to assets, right? So equity plus liabilities, which is debt. So the higher this number is, okay, it means that the more debt we have relative to assets, because if this number is getting bigger, it means that the equity is very small relative to the assets, right? And that means we have a high amount of debt or higher financial leverage. So we are implicitly measuring how much debt a company has relative to its total assets, right? And that's because assets is equal to equity plus debt. So even though this equation doesn't have the word debt in it or liabilities anywhere, that's exactly what we're actually measuring. We're just measuring how levered is this company. So the higher this number is, it means that it has more assets relative to equity, right? So the equity is very small relative to the assets, and that would imply that there's a high amount of debt, and that means we have higher financial leverage. And vice versa, if equity is very high relative to assets, then this number will be quite small, and that means we don't have a lot of debt. So when we have higher financial leverage, it implies, as we said, that the company has higher debt levels. So that's usually the case, but not always. Okay, so when we look at one of our examples, which is Hindustan Unilever, we will see that higher financial leverage does not necessarily mean that the company must have higher debt levels. And higher leverage leads to higher return on equity. So it's part of the DuPont identity, right? It's a third component, and when that goes up, then the ROE also goes up. And intuitively, if we think about why is this the case, it's that let's say you have very, very high leverage, right? So you have a lot of debt relative to your equity. So the amount of debt you have is quite large, and the amount of equity you have is quite small. Now, what this means is that if I'm just looking on your return on your total equity, because my equity is so small, okay, that ROE becomes very high, right? Because equity is on the denominator. So that's some kind of intuition as to why financial leverage, so the more levered we get, the more debt we take on, the higher our ROE goes up, right? And that's just because we just don't have as much equity relative to our total assets, right? Equity is quite small. So this is also one of the components driving ROE. And here you can kind of get a sense for why perhaps higher ROE is not always doesn't always indicate strong performance. If it's the result of taking on lots of debt that may not be sustainable, then that's definitely a problem, right? And that's why we like to look at all the components of return on equity in order to really understand what is driving it. Using DuPont analysis. Now that we have had a chance to look at what are the components of the DuPont analysis, so we've looked at the three specific components, which are net profit margin, asset turnover, and financial leverage. Our next step is to understand, well, how do we use this information, right? Why do we care about this? And we've alluded to this a little bit earlier, so let's look at why this is important. The purpose of DuPont analysis is to understand how exactly a company is generating its return on equity. Now, typically when we look at return on equity, we think of that as a nice summary statistic of how the company is performing, but usually it's not enough to really understand what's driving the business. And that's why we need to break it down into these three components so we can get a feel for why exactly their return on equity is either high or low. And one of the points that we alluded to earlier was that we tend to find very stark differences in the different components of the DuPont analysis depending on the industry in question. So, for example, retailers tend to generate their return on equity through high asset turnover. Right, so that means they make a lot of sales, right, relative to their total asset base, and they tend to generate their return on equity through making lots of sales, right, through volume. On the other hand, you have luxury industries that tend to generate ROE through high profit margins. Now, luxury industries, as we know, will probably have fairly low volume, right, because they're catering to a small number of customers. But because they're selling luxury goods, they tend to price these goods quite high, and as a result, the profit margins on these goods are high. And that's how luxury industries tend to generate ROE. And finally, financial companies, for example banks, tend to generate ROE through high leverage. And this is kind of not necessarily a bad thing. I mean, we've obviously heard of banks being too levered and them suffering as a result. But what we mean here is that banks take deposits, which for them are their liabilities, and then they make out loans. And so their total equity tends to be quite small because of the large number of deposits they take. Right. So if we look at their equity relative to the assets, the equity is quite small, which means that the assets over equity becomes quite big. So this is, in this sense, financial companies tend to generate their ROE through high leverage. And these kinds of facts are pretty typical. You can think of other industries as well, and you can usually think through, given their business model, how exactly do they generate their returns, right? What is their business plan? What is their strategy? And what do they do in order to generate high returns on equity? And at the end of the day, ROE is important because we are also equity holders as investors in the company. The more the company can make, the better off the investors are. Using DuPont analysis. So let's carry on our discussion about DuPont analysis and some of the uses for it. And because we've talked about how DuPont analysis tends to vary a lot across industries, as you can imagine, it would not be very useful for comparing companies across different industries. Right? So I would not want to be comparing, for example, a luxury brand and a retailer, because the things that generate their ROE are quite different. Their business models are not the same. So it's not directly comparable to say, this person's or this company's financial leverage is higher, or this company's asset turnover is very low. It really depends on the industry that we're interested in. So typically we would use DuPont analysis in order to compare companies within industries. So it is very, very useful when we're looking at the same industry. Okay, so if I'm looking at two companies in the same industry, then DuPont analysis becomes very useful. Right? Then I can see exactly where one company may have an edge over its competitor, right? By looking at the breakup of ROE. And one caveat to return on equity is that high ROE is not always a good sign. It really depends on what's generating the higher ROE. So it's really important for us to do this analysis so that we can understand truly, well, what is generating the company's ROE, and is this a good thing or is this a bad thing? So for example, one of the main things that we would see as not a good sign, even if ROE is high, is if a company has excessive leverage. Now, we did talk about banks and how their business model requires them to have lots of leverage, but if you're just looking at a non-financial company where leverage need not be a part of their business model, if we were to compare two companies, let's say in a particular industry, for example, let's say we're looking at the auto industry, where you wouldn't expect extremely high leverage. If we were to compare two companies in the auto industry and we found that company A had a higher return on equity, we may think that this is good, but if we perhaps we looked at the financial statements and saw that, Well, their ROE was basically due to higher leverage as compared to their competitor, right? And then that's not necessarily a good thing. That doesn't mean that this company is actually better at generating returns, right? And that's the key here. We want to understand, is this company good at generating returns? And generating returns through excessive leverage is not necessarily a sign of strength for the company. And the other problem with high leverage is that it tends to mean that the company has high interest payments that it has to pay on its debt, and if it were to experience a negative shock, for example, a recession or something like that, then if it had these interest commitments, it may make it difficult for them to meet their obligations when times are bad, right? Whereas a company with low debt typically can better absorb crises and better absorb shocks because they don't necessarily have that interest outflow every year. So this is how we tend to use DuPont analysis, and these are the kind of caveats that we need to keep in mind. Examples. So now that we have had a chance to talk about DuPont analysis and the theoretical side of DuPont analysis, so we understand what it is, how it works, and what are the components, the next step for us is to look at some examples. So for the second half of this lecture, we're a little more than halfway done, but for the rest of this lecture we will talk through about 3 examples in quite a lot of detail. And we'll look at 3 different companies that are in different industries with the aim of showing how they generate their ROE in different ways. So we said that different industries will generate their ROE in different ways, right, depending on their business model. So now we would like to look at some examples of this and see it in practice, right? See how do these companies in different industries generate higher ROE, and how is that a result of their business model. So we're going to look at 3 different companies. We'll discuss HDFC Bank, we'll discuss Hindustan Unilever, and we'll discuss National Mineral Development Corporation. So again, before we carry on to this, let's keep in mind what is the aim of discussing these examples. Examples are a very good way to apply our theory into practice, and that's what we want to do here. We want to apply what we've learned about DuPont analysis and learned about the different components, and actually just look at some examples of companies. All right, so we'll be looking at some summaries of the financials for these companies, and then we can look at each of the 3 components of the DuPont analysis. This will then give us the return on equity, and this will then allow us to better understand how the ROE is generated. HDFC Bank. So the first example we'll look at is HDFC Bank. HDFC Bank is a very popular and common bank. I'm sure most of you know of it or maybe even use it. So HDFC Bank is a financial services company, and they are one of the largest in India, and this is evident by the fact that their brand is so well known. They have operations in retail banking, wholesale banking, and treasury services. So retail banking is about dealing with customers and customer deposits, and then we have wholesale banking, which is for wholesalers, perhaps larger companies, and we also have treasury services. Now they are a financial company, and as we talked about earlier, they tend to generate their ROE primarily through high leverage. So when we talked about leverage and we talked about using DuPont analysis, we said how financial companies tend to generate money through leverage, and HDFC Bank is certainly a good example of that. So if we look at HDFC Bank's 5-year average financial leverage, it's equal to 11.2. This is very, very large, because if you were to think we're taking assets divided by equity, and if assets divided by equity is above 11, it means that the equity only comprises around 7-8% of the company's total assets, and the rest is debt or liabilities. So even though this is a high number, okay, it's very common for a bank. So given that we're looking at a bank, this number is actually is fine. It's in a good level. If this were any other company or another industry, then this would be extremely high. And this kind of underscores the importance of keeping the industry in mind whenever we're looking at a company's ROE and the generators of its ROE. So HDFC Bank has a high financial leverage, and that's because they take a lot of deposits, right? And then they make loans against those deposits. So the fact is that because they're deposits are so high, it means their loans and assets are very high, so their total equity ends up quite low. And this is normal for a bank, and it explains how the bank generates their returns. So as we said, banks primarily receive deposits that they lend to their customers, which means most of their loans are funded with liabilities rather than equity. Okay, and this is kind of the key thing that distinguishes a bank from other industries, is that the job of a bank is essentially to take money from depositors, and perhaps they pay a certain interest rate on that on those deposits, and then they lend that money out to their customers, and they earn a higher interest rate from their customers than what they have to pay on their deposits. Right, and that's kind of the interest rate spread that they earn, and that's how banks make money. But in terms of leverage, it does mean that they tend to make loans from their liabilities, right, in order to earn that interest rate spread, which means that all their assets are funded with liabilities, right? All of their loans are used with their customer deposits or liabilities, rather than them using equity to make loans. Right, so they don't tend to use their equity to make loans, and this is why the liabilities of a bank are extremely high. Correspondingly, the assets become also very high, and then the equity becomes a very, very small component, and as a result, we end up with a high level of financial leverage. HDFC Bank. So now what we are going to do is we are actually going to look at the numbers behind the return on equity that we talked about. So HDFC Bank, as we mentioned, has very high levels of financial leverage. So if we look over here in these top 4 lines, we see the net profit margin, the asset turnover, and the financial leverage, and the return on equity is simply the product of these 3 items. We multiply the 3 items by one another. So what we can see here is that a lot of this ROE is generated via having very high financial leverage. Right? As of March 2013, they have a financial leverage of 11.1, and this has been pretty constant throughout the last 5 years, never going below 10 and being as high as 12.2 in 2009. Their asset turnover is quite low, so we have 0.1. So this kind of offsets the financial leverage. The net profit margin is fairly decent. 19% is quite a good number. Financial leverage very high, asset turnover quite low, but the product of those two means the ROE is good. So 18.6 is definitely a good ROE, and we can see that the ROE has been increasing over the last 5 years, and this has primarily been driven by increases in net profit margin rather than increases in leverage. So finally, we can just quickly look at how these numbers are calculated. So net profit margin, we take the profit after tax, okay, and divided by the interest earned, and interest earned for HDFC Bank is essentially their income, right, their sales, so that's the net profit margin. And then the asset turnover is going to be their sales, or the interest earned, divided by their total assets. So here we can see that it's a pretty small fraction of their total assets, right? It's not like a retailing company which would sell multiple times their total assets. And finally, we have shareholders' funds, and this allows us to, this is straight from the financial statements. So with these 3, we have that net profit margin is profit after tax over interest earned. Asset turnover is going to be interest earned over total assets. And finally, financial leverage will be assets divided by equity or shareholders' funds. Right, and these 3 formulas are constant throughout. So this is quite an interesting is a very interesting way to analyze a company, right? Because it really allows us to understand what is driving the return on equity for this company. And we can see that one of the main reasons it's quite high is due to the fact that they have a lot of financial leverage. But this is very, very common for a bank, so this is certainly not something that we would view as a bad sign. In fact, HDFC has proven themselves to be a very strong player in the banking industry. So this is definitely these are definitely strong financial statements and good numbers. Hindustan Unilever. The next company we'll talk about is Hindustan Unilever, and they're also a very large company, and chances are they're a household name as well. Hindustan Unilever is India's largest consumer goods company. So what do we mean by consumer goods? Well, consumer goods means that they sell foods, beverages, personal care products, and cleaning agents. And as an FMCG business, their ROE is primarily driven by high asset turnover. So FMCG stands for fast moving consumer goods. Okay, and from that acronym alone you can probably learn something about their business, right? So the consumer goods portion refers to the fact that they're selling consumer goods, which we've already discussed. Fast moving, that means that they sell things very quickly, right? So they sell products and they sell them again and they sell them again and again, and this is really about asset turnover, right? So their ROE is driven by high asset turnover, and that's what put them in this particular category. So FMCG is actually an industry category, right? It's a category that we used for companies in this industry. So these industries all are fast-moving consumer goods, and as you can expect in that type of business model, the ROE will be primarily driven by high asset turnover. Their 5-year average asset turnover is 2.1, okay, meaning that their total sales is just over double their total assets. So that's quite a large number, right? It means that, you know, a company's assets can be quite big, especially one like Hindustan Unilever, and they're actually making sales that are double the level of those assets every single year. And this number is actually a little bit deceiving because it should technically be even higher, because if we were to consider just operating assets, then this ratio would be much higher. So operating assets refer to assets that are used in order for the regular running of the business, so not including things like goodwill, for example. So these types of numbers, like 2.1, is quite typical for FMCG companies, right? The fact that they are fast moving implies that you would likely get high asset turnovers. Another contributor to the high ROE is the company's financial leverage. So Hindustan Unilever has a fair amount of leverage as well. The high financial leverage is not because of debt. In fact, the company is actually debt-free. The reason we have high leverage is because of the presence of large non-interest-bearing liabilities. So the company has liabilities for which they don't pay interest on, so that's why it's debt-free. But it does, it is part of their liabilities, and this means that their leverage is relatively higher. And the way they do this is that they are able to extract very favorable terms from their creditors due to their high bargaining power. Right, so because they're so large, they can buy a lot of things on credit, right? And that accounts for the fact that they have these non-interest-bearing liabilities. So most of its assets are actually funded by its creditors, which is quite unusual, and it signals, you know, a fairly strong company. So this is also an indication of the presence of a very strong economic moat, right? The fact that they have all this bargaining power that they can buy on credit fairly easily indicates that this company is quite strong, and they certainly have a very strong economic moat. So that's Hindustan Unilever, and with this type of company in this industry, the FMCG industries, we tend to see high asset turnovers. Hindustan Unilever. Now, for Hindustan Unilever, we talked about how they had a high asset turnover and how this was one of the key drivers of their return on equity. And we also said that they have a fair amount of leverage, a reasonably high amount of leverage, which is not due to high debt, it's just non-interest bearing liabilities, so essentially advances from creditors, or a delay in payments to creditors, the fact that they can take their time and buy things on credit. So let's take a look at the trend for these numbers. So we have profit margin starting at 12.4% going up to 14.7%. Slight increase over the 5 years, but again, this is not an extremely high number. This is it's fairly good for a retailer, but in general, we would not consider this to be an extremely high number. Their asset turnover is very strong, right? They're selling, usually 2 times their assets or more. So here's 2.5, then just under 2, and then 2.2 as of 2013. So that's very, very good, and this is kind of the way in which they're generating their ROE. And finally, we have financial leverage, which we mentioned before, and this is also quite high, between 3 and 4 on average. And what this results in is extremely high return on equity numbers, right? We have return on equity of 132% in 2013, 73% in 2012. So these are extremely high numbers. And this is the combination of having a healthy profit margin, a very high asset turnover, and also a fair degree of financial leverage, right? So these 3 components together, so Hindustan Unilever tends to have a high asset turnover as well as a fairly high leverage, and profit margins are very good, not extremely high but good, but 2 out of 3 numbers very high will give you a pretty high return on equity. So as a result, the return on equity is definitely very good. It has fluctuated quite a lot. We can see it started at 117% 5 years ago, going down into the high 70s, early 80s, and then 73, and then way up again to 132. And some of these has been driven by, it seems to be driven by a combination of all factors. So if we look at 2012 versus 2013, we had increase in the net profit margin, increase in asset turnover, and an increase in financial leverage, of which all the combination led to a much higher return on equity. And down here, we again have all these numbers for financial statements. So net sales, which we use to calculate the net profit margin. So that's going to be profit after tax divided by sales. And then we have profit after tax, we have total assets, and then we have shareholders' funds. Okay, so this hopefully gives us a nice idea of Hindustan Unilever and their financial statements, and what exactly is driving their return on equity. National Mineral Development Corporation. The third and final example we'll look at is National Mineral Development Corporation. So National Mineral Development Corporation, which we'll abbreviate as NMDC, is a state-run company involved in mining and producing various minerals. Okay, we can claim, this is evident from the name of the company. National meaning, perhaps it's involved by run by the government. Minerals, that they're looking for minerals, etc. So the main things that they mine for and produce include iron ore, copper, as well as many others. They are India's largest iron ore producer and have high exports in this area. So this company is producing for not just India but other parts of the world as well. NMDC generates its ROE primarily through high profit margins. So now let's think about why a company like this, so this type of industry, which is mining, would have high profit margins. Well, in general, mining is something that a company can mine something, and it's usually not too expensive to mine, right? There's a high fixed cost involved, but once the setup costs are accounted for, you can mine quite a lot, and whatever you find, then you can sell as your products and generate revenue that way, right? So you don't necessarily need to pay for the iron that you're finding. You just need to find it, and then you can sell it and earn profit that way. So as a result, NDMC generates ROE primarily through high profit margins. So let's look at some numbers here. So the 5-year average net profit margin is 58.8%. This is extremely high. You would typically not find such high levels in most companies, and this is because the cost of mining and producing the minerals is much less than what they earn in revenues from selling them. And you might ask yourself, well, why don't they have more competitors that could, sell it cheaper, and this would erode profit margins? Well, the reason being is that to be a mining company, you require, a lot of licenses, you require land, you need a lot of equipment. So the barriers to entry into this type of industry are fairly high, right? And because of the high barriers to entry, it means that, they can sell their minerals at a fairly high price, and more than cover the cost of their production as well, and make a strong profit for themselves. So this is an example of a company that does develop that creates the ROE primarily through net profit margins. National Mineral Development Corporation. So our final example that we're looking at is NMDC, and NMDC generates their return on equity through a high profit margin. Okay, so let's take a look at some of their numbers. So we see return on equity, which is fairly high, so 37%, 24%, and in March 2003 a little bit lower at 23%, but definitely good numbers nonetheless. And let's take a look and try to understand what's driving this return on equity. And what we see is that we have a fairly low asset turnover. It's fairly small and constant throughout the 5 years. Financial leverage is also reasonably small and also constant through the 5 years. So really it's the net profit margin that's very high, and that's what's driving the return on equity. Okay, so the net profit margin, we have net profit margin of 58%, 55, 57, 64, and 59. So these are extremely high numbers, and this is really what's driving the return on equity. And also, if we look at the movement over time, is the net profit margin is moving over time, and that's what's driving the changes in return on equity, whereas these other two are not really changing very much. So that's also something important to keep in mind. So definitely we can see that, you know, their profit after tax, if you look at, is 43,700, and their net sales is 75,600. So most of their sales end up as profit, right? And this is kind of reflected in the fact that we have this fairly high profit margin. Okay, so that concludes the analysis of this company, NDMC, as well as the analysis of our examples. So in our examples, we have had a chance to see 3 different types of companies in different industries and look at how their ROE is generated, right? And we can see that depending on the industry, the ROE may be generated in very, very different ways. So we had HDFC Bank, which generated its ROE primarily through financial leverage, high leverage. We had Hindustan Unilever that generated its ROE primarily through high asset turnover and also fairly high leverage. And here we have NDMC that has generated their return on equity primarily through high net profit margin. Okay, so let's now go back into the PowerPoint and conclude. Conclusion. So this now concludes our lecture on financial ratio analysis. This is part 2 of financial ratio analysis. And in this analysis, we've mostly focused on DuPont analysis, which breaks down ROE into the product of its 3 components, which is net profit margin, asset turnover, and financial leverage. So net profit margin looks at, you know, at the company's net profits as a percentage of their revenues. Asset turnover looks at the revenues of a company divided by its assets, and financial leverage looks at the company's assets divided by its equity. Now, the purpose of DuPont analysis is to understand the factors that drive the ROE for a particular company. So by breaking it down into these 3 components, we can better understand how a company generates its return on equity. And as we have seen, the primary factors vary considerably depending on the industry in question. Right, so depending on the industry and depending on the company's business model, the ROE will be generated in very, very different ways. So that concludes this lecture. The next lecture is on identifying accounting red flags. And you know, we've been looking a lot at, you know, financial statements and accounts in the last few lectures. And in the next lecture, we're going to turn to accounting red flags and identifying these things. Red flags means, you know, something that perhaps is a problem or indicates something bad is going on here or something wrong is going on. And you know, it's unfortunately the case that sometimes companies will misrepresent their accounts in certain ways, and we'll talk about you know, how they might do this and how as analysts we can identify it. Okay, so thank you very much for listening, and see you next time.